He's actually a research associate. He's a fresh graduate out of Thunderbird, very smart guy, but he's not going to be an analyst on the team. We don't start out our members on the team like that. We basically let them start as associates. They have to learn the ropes, understand our philosophy of investing, but he's going to be closely working with all the portfolio managers and the senior analysts. So those are the two additions overall to the team. And then we have also added another member who comes to us with a tremendous amount of experience, but it's more on the business development side. And he's going to be running our institutional financial intermediary segment. And what that means is we get a lot of inquiries from a lot of platform providers, the 401k, DC plans. So this particular individual, that is Chris Walsh, is going to focus on that. So though we've added 3 employees to the organization in this year, we still are a very lean, mean shop. We manage about $50 billion, as I mentioned earlier, but that's across 65 employees. We are running these 6 products, and we're based out and headquartered in New York. If you turn to the next page over, page number 5, that's the investment team. So about 40% of the staff is the investment team overall. So we're very focused in really managing the portfolios and our clients' money overall. And the column to the left, which is really the portfolio advisor column, that's where Doug is, and Ben has been added on. If you were to look at the presentation when we came over here to the committee about 3 years ago, not much really has changed. We like it that way. We like the stability of the team. The team continues to get paid 1/3 of their total compensation invested back in our own products with a 3-year lockup. So there's a direct skin in the game. There's also a retention aspect to it. But more importantly, you've really got to buy into the philosophy and the way we manage the money. And that's very key to the organization. Any questions so far? Okay, so I'm turning on to the next section here, page number 7. So the mandate that we are managing for Oklahoma City Employee Retirement Systems is in the commingled vehicle. And the fund is such that the more the assets within the fund, the fees start to drop. So you do get the benefit of basically the fund now being at about $2.9 billion. The total fees these are all-in fees, are about 86 basis points. So it's a fairly competitive fee. And the inception of this account was in 2012, June 1st, with $18 million. As of March 31st, 2015, it stands at about $21.5 million. So in less than 3 years, we certainly have added to the upside. And again, we thank you for your confidence. It's certainly a privilege to serve your mandate. So thank you for that.
And Ahmed, just to be clear, when you say all-in fees, that includes the custody and administrative fees as well?
Correct. Yes, it's management, custody, administrative, reporting, all of that. It's an all-in fee. That's right. So before I turn it over to Doug, I'm actually going to really quickly highlight the philosophy of our investments, because that is really at the heart and the root of how the portfolio gets constructed. We basically believe, and that's how we're looking for investments in companies that are very earnings focused. We want earnings to really drive the construction of the portfolio, and certainly valuation. So we believe if we get the earnings right, the performance will follow. The price will follow, ultimately, and valuation. So it has to be at the right valuation as well. So when we're looking for building the portfolio, we're looking for quality companies. These are high-quality companies that have generated high return on equity, free cash flow generating ability. We don't like a lot of cyclical companies that have a lot of high CapEx in general on their balance sheets. And they have to have a very strong earnings growth profile overall, consistency in the earnings growth profile. And what that translates to ultimately is really introducing lower volatility within the portfolio. And I think it's very important, the lower volatility aspect of it, because that is what is very prevalent more so in the emerging markets. So our objective overall is to look for these companies, these 50 to 90 companies, and build a portfolio from the ground up. So we are fundamentally bottom-up driven managers. though you might find that there are certain themes, but those are more byproducts within the portfolio, like, for example, our overweight to consumer staples. But overall, our objective is to deliver 2 to 3% net over the respective benchmark over a full market cycle. And for us, a full market cycle is 5 years. And we do expect to outperform the benchmark over that time period of 5 years by 2 to 3% net, with about 20% less volatility to the benchmark. So we are a concentrated portfolio. We look at about anywhere between 50 to 90 holdings. Right now, the portfolio is at about 75. Whereas the benchmark is over 825 plus holdings. So there is a little bit of a concentration built in. Page number 8 gives you more details on the account per se, the breakdown over there. But turning on to the next page here, page number 9, this highlights the performance since inception to the account. And if you look at since inception, we basically have outperformed 120 basis points to the benchmark. Certainly our 2-year number, 1-year number, our last year was extremely attractive to emerging markets. The first quarter we have, on a relative basis, underperformed the benchmark, but on an absolute basis, we are about 1.55% positive net, that is. Again, for us, it's really not a quarter-to-quarter story. It's really the story of the long term, where we expect the portfolio to deliver that 2 to 3% net. Doug's going to get more into really what contributed and detracted to the performance in the last quarter. But if you were to turn to page number 10, that highlights really the upside-downside risk capture, also the volatility, one of the volatility metrics in general. And what this page highlights here, if you look to the ones to the graphs on the right, the top one is a 5-year number, the lower one is a 10-year number. And what that tells you is every 100 times the market goes up, we participate on the upside. But every 100 times the market goes down, we do protect the capital on the downside as well. So we're participating in the growth, and we are protecting the capital. So there's certainly that preservation of capital, plus the orientation of growth aspect built into that. So if I were to really summarize in terms of what happened in the last quarter, and I'll turn it over to Doug just very quickly. From a country standpoint, the portfolio has done well because of India and our overweight to India and Brazil. China certainly has contributed a little less to the performance overall, and from a sector standpoint, it's the financials and technology that did well for us. But I'm going to let Doug really get more into the details as to how it's positioned overall. Great.
Good morning, everybody. My name is Douglas Bennett. I'm a senior portfolio advisor at Vontobel Asset Management. Been with our firm just going on 3 years. I'm going to talk to you over the next 20 minutes about our portfolio. Please, if you got questions, feel free to interrupt me. Maybe just as a background, I don't know if any of you had a chance to look at the Wall Street Journal this morning, but there's a very interesting front page article on India. It's about the Modi government, who Mr. Modi is the prime minister. He came to power in India about a year ago. India is the biggest democracy in the world. There were some 850 million people who voted in that last election. They voted for Mr. Modi and his party and voted really for change, for moving the country forward. It's had a rather backward, sclerotic, very bureaucratic government for the past 10 years. The Congress Party was running the show. But really, that's one of India's biggest problems, is just that it's backward, sclerotic, and very bureaucratic. Mr. Modi has come in to change things, but that's not going to happen overnight. And this article in the Journal today talks about that. It's focusing on one company in particular, which is Coal India. Coal India is one of the biggest coal companies in the world. I think the article suggests it's going to become the biggest. India is going to become probably the biggest burner of coal in the world. We're going, obviously, in another direction in this country for environmental reasons, I think. But India's got a lot of coal, and they look at that as being a cheap way to supply energy to their electricity grid. The electricity grid, particularly in the summertime, tends to have a lot of brownouts and blackouts. They basically don't have enough power for all the people there. There's some 1.3 billion people. Some of these cities are mega cities, Mumbai or Bombay, for instance. I think the population's going up towards 25 million people. So there's a lot of work to be done. What's interesting is that they show pictures of people carrying coal basically on their backs, and some of the statistics that are good to keep in your head. This company employs about 330,000 people. The average age of these miners seems to be between 45 and 50 years of age. So there are a lot of, let's say, older people that shouldn't necessarily be miners anymore. But they're kept on because of the unions. The unions are very powerful in India. But the telling statistic is that they produce in an average day, the single mine worker, about a quarter ton of coal, which we in this country with our machinery and the more advanced techniques produce in 5 minutes. So the average mine worker in this country in 5 minutes produces the same amount of coal that the average Indian produces in a full 8-hour shift. Pretty amazing statistic. It tells you really what the opportunities are in India if they can get their act together. The average GDP today is about $1,500 per person. We're looking at many, many times that in this country. Even China is now up to about $10,000 per person. So India's got a lot of potential. If you look at our allocation to that country, it's about a quarter of the portfolio right now. So we see a lot of opportunities. I think you do too. That's why you're invested with us in emerging markets in our fund. So that being said, I just wanted to talk briefly about what's been going on with the portfolio that you're invested in. We show on page 11 some highlights of the first quarter, and they aren't really new news. Brazil has been mired in a recession for a couple of years. Unfortunately, they're still sitting at about 0 to maybe 1% growth. That has a lot to do with their government. They've got a very left-leaning government that was reelected last November. Mrs. Rousseff, Dilma Rousseff, is the president, and there is a scandal that's been going on with that administration, started before she was reelected, but it's continued, concerning Petrobras, which is the biggest oil company in Brazil, that they were making payments to the party of Mrs. Rousseff, the Workers' Party, in order to get reelected, in order to get favors and all. So that's not helping the situation there. We do own a number of companies in Brazil. Our allocation there is about 13%. We're invested in companies primarily in the consumer space and the financial space, so a couple of banks, also a credit card company called Cielo that competes with MasterCard and Visa, has a very strong presence in Brazil. But basically what we like to own there are companies that are in the consumer space, such as a cigarette company called Souza Cruz, a brewer called Ambev, which has a 90% market share in Brazil. These are the kinds of companies that are going to do well even in a low-growth environment. So we do like Brazil. Over the longer term, understand that it's a young democracy going through problems just like India is. It has a lot of potential for the moment. We're taking a quite cautious view in the types of companies we own. They're generally producing good returns because people continue to smoke and drink, even if the economy is not growing very much. Otherwise, we own some companies in China, some internet names. You may not know them as household names, but in China they're very, very important. One is called Baidu. It's the Google of China. It's got some 600 million users. Not just in China, in fact. There are a couple 100 million Chinese living outside the country, and they tend to go to this site when they want to look up something in Mandarin, in their language. We also own a company called Tencent. It's a social media site, patterned a bit on Facebook. Another company called Alibaba, that is an e-commerce site, does a lot of B2B commerce. It's actually not even considered a IT company. It's considered a company like Amazon, a consumer discretionary company, so a company involved in making goods and services trade between different businesses. These companies generally didn't do that well in the first quarter. China's been on a real tear over the past, I'd say, 6-8 months. The market has doubled. It's a lot of state-owned companies, banks, for instance. The Chinese economy is controlled, obviously, by the government there, the Communist Party, and most of the big companies, whether they're in the banking sector or in the materials sector, tend to be state-owned. We shy away from those kind of companies because we don't think that the government has necessarily our best interests at heart. So we tend to invest in private companies. I've mentioned a couple of them in the internet space. We own a brewer called Qingdao that you may have seen if you've been to a Chinese restaurant. But these are companies that we trust, that we feel are interested in increasing their profits and will be more attuned to what we're looking for in terms of long-term earnings growth. So that's pretty much it in terms of the situation. I think I've painted it a bit for you, talked about some of the biggest countries in the world. In general, emerging markets have slowed down their growth. China's looking at about 6%, 6.5% growth this year. It was growing in low double digits 5 years ago. Because it slowed down, that's hit Brazil. Brazil's a big exporter, has been a big exporter of raw materials to China. That's hit a few other countries. South Africa, for instance, it's also a big exporter of raw materials. Indonesia. So there's been a bit of a domino effect. India is going the other direction. India was growing at about 4% 2-3 years ago. This year they're looking at about 7.5% growth. With more to come over the next few years. As I said, India is way behind China even. It's got a lot of potential if it can get its infrastructure going, if it can get its bureaucracies moving more efficiently and such. And you can see why we are quite interested in that country. If you look at the portfolio, page 13 shows the top 10 and some changes we made. These companies that we show here are companies that are in the countries I've mentioned, in the sectors I've mentioned, be it tobacco, be it the brewing sector, or the internet sector with a company like Baidu, or Taiwan Semiconductor, which is the biggest producer of DRAMs worldwide. All very, uncomplicated companies in our mind. We try and keep things simple when we invest. We're looking for growth over the longer term. The following page shows the allocation by sector. You can see we've got about 40% in the consumer space, another 27% in financials, and in IT is about 16%. So that's basically where our portfolio is. We tend to shy away from companies in basic resources, companies in the industrial space, and then lower growth companies, we think, in the utilities and telecom space. So that's why you see these underweights, for instance, to energy, where we've got just one small company in Brazil, in industrials, where we have essentially no weighting at all, and then in telecoms and utilities, where we're both underweight the index. Any questions about any of this so far?
And that's a constant theme. You're not the staple, overweight to staple, or consumer staples, consumer discretionary, financials hasn't changed over time.
Yeah, so in answer to that, you've been with us for a couple of years. We've not changed things radically in any way. We've tended to have a greater exposure to India, for instance, been underweight China for the reasons I mentioned. We've tended to have more of an exposure to consumer companies. I think that's probably one of the reasons you hired us. The consumer companies give us a lot of stability. They're going to do well. They're going to keep selling their products, whether it's deodorant or beer or shampoo or cigarettes, in good times and bad. And as I said, a perfect example is Brazil right now, where there isn't much growth in the economy, but our companies are continuing to sell their products there. They're low-ticket items. You know, people buy them because they need them, and also they're interested in brand names just like we are. They're looking to trade up over time. Good example with beer in Africa. A lot of people drink a beer based on sorghum, which is a very inexpensive grain that's found locally. But SAB Miller, which is the old South African breweries, in which we've got a stake of about 3%, is slowly introducing its brands there, and these are still a lot of local brands. They have some international ones, such as Grolsch out of India. They have Pilsner, which is a famous Pils out of the Czech Republic. But they've got a lot of local brands in South Africa or Angola or Mozambique or Nigeria. As people become more wealthy, they're trading up to these beer brands. So they want to get away from drinking the local brew and trade something that's a little bit fancier. So we're enjoying this phenomenon. We think it's a long-lasting one. And so, yes, we've been overweight in consumers for some time, and we're going to stay that way. We think that's where the growth is longer term.
So can you touch on, I know this report goes through March, but April?
Yeah, so we show some performance, and my colleague Amit talked about it. That's on the pages, 16 to 18. There's that bubble chart, which we show in each of these quarterly reports as a way for you to picture where we are in terms of the asset allocation. So you can see those two big bubbles, consumer and financials, for instance. That shows that we have quite strong exposures there. If you think of this as a four-sector grid, where we'd like to be with all those bubbles is in the upper right-hand corner. That would mean that we've picked the right sectors and we've picked the right stocks within those sectors. In fact, we didn't. In this case, we've done okay with the financials, you can see, done okay with healthcare, didn't do very well with IT. If we're down in that lower left-hand corner, then we basically didn't pick the right stocks, and we didn't do particularly well in the sector either. But that happens on a quarter-to-quarter basis. We don't worry about it too much. Regarding the year-to-date performance, or at least through the end of April, the market, excuse me, I can give you as of yesterday even, the market, the EM market's up about 8.5%. The S&P, by the way, is up about 3%, so emerging markets are doing relatively well versus the S&P this year. We're only up 4%, so we're underperforming the market year-to-date. Again, we don't worry about it too much in terms of, we look at that as short-term performance. What we're trying to give you is long-term performance over 5, 10, 15 years. We hope that you'll stay with us that long and give us a chance to prove that we can provide you better performance in the market over the longer term. But why we've underperformed? Well, China's been on a tear, as I mentioned. We tend to be underinvested in China, tend to not own these state-owned companies, so we've underperformed in China a bit. India's had a very good run over the past 15 months. Since Mr. Modi came to power last May, the market rose about 25%. But over the past few weeks, it's slowed down a bit. And again, I point you to this article in the Journal today. It kind of explains why. There's a lot of stuff to be done in India. Investors probably got too excited about it. And now they've taken some profits, moved on to China, moved on to other places. We're staying the course. We're staying in India because of the potential there. But because of that, we've had some short-term underperformance. There are one or two other countries, but those are really the highlights in terms of the performance here today. So just, to conclude, looking forward, I think that we do take the long-term view. We think that, as I've mentioned, that Brazil's got a lot of potential. They've got some teething problems right now, but we think they'll get through them. And so we like Brazil. We've been using the weakness in the markets to add to some of the positions. The currencies have been a bit weak. That helps us as U.S. dollar investors, for instance. China, we're a bit concerned about. China's, as I said, doubled since last fall, and we think that is a bit of a bubble. It could go on for a while. That's the way bubbles tend to behave. They go on longer than you expect. But we're not going to chase it. We don't want to pay more now than we would have paid 6 months ago, and we certainly don't want to change our style of investing to go into companies that we just don't think are the right kind of companies for our investors. India, I think I mentioned that enough times that we're very, very positive about it. It just takes patience. So we're going to stay the course there. And there are a few other countries, be those Thailand or Mexico or Indonesia or South Africa, where we see wonderful potential. We've got individual companies there that we like that are growing over the longer term. And we're not particularly worried. Where we do tend to underinvest is in a few countries such as Turkey or Russia, where we just feel that things aren't very kosher in terms of how the government's running the show. Again, just like in China, if we don't feel that the companies that we would invest in would have our best interests at heart, then we're going to stay away from them. Any particular questions?
You got a question, Mr. Chairman?
Go right ahead, sir.
Please excuse my ignorance. How do you define emerging markets? What's the criteria for an emerging market versus developed countries, for example?
Yeah, to be honest, I don't know.
It's a good question.
It's the MSCI is the index everybody uses, so it's the Morgan Stanley, composite index, I think it is. They do regular reviews, I think on an annual basis. Last year they dropped Greece, said you're no longer a developed market, you're going to fall back to become an emerging market. They raised a couple of the Middle Eastern countries. I think it was one or the other of the Emirates. Hong Kong, for instance, and Singapore are both considered developed countries, but Korea and Taiwan are not. Don't ask me why. I think these are the 4 Asian tigers. They probably are all pretty similar these days in terms of their GDP per head, which is on the order of $40,000 or $50,000. You could imagine at some point Korea and Taiwan will probably both get bumped up. China and India are way, way far away from moving up into that developed market area.
Well, how much of this portfolio can you invest outside of emerging markets?
Yeah, so you may notice we have a bit in the UK.
Yeah.
Okay, so quick explanation there. When we look at emerging markets versus developed markets, we're looking at where is the end demand of the companies that we're investing in. So we don't worry so much about where their home base is, but rather where are they getting their economic profits from. In order to invest in a company, it's got to have at least 50.1% of its economic profits coming from an emerging market. So there are 3 companies we own in the UK. 2 of those I've mentioned. I think BAT, British American Tobacco, and SAB, so South African Breweries, are both based in London, but they have respectively BAT about 65%, about 2/3 of its profits coming from emerging markets. Primarily, its big markets are Russia, Brazil, India, and Indonesia. And then South African Breweries used to be down in South Africa. When apartheid ended, they moved the company up to London. They are one of the big 4 brewers globally, but they are the brewer that has the majority, by far the majority of its profits coming from emerging markets. So they get about 40% from Africa, about 30% from Latin America, and the other 30% comes from Australia. They own Foster's. United States, they've got a joint venture with Coors that owns Miller here in this country, and then a few countries in Europe where they make a little bit of profit.
So you don't have a limitation so long as the company has basically a majority of the profits outside of the developed country?
Yeah, we could own a company in this country if it was making more than 50% of its profits in emerging markets, theoretically. We've tended to focus on these UK companies. They've been international. They've been focused on emerging markets for 100 years. I didn't mention the other company is Randgold, which is a gold mining company. They're listed in the UK, but 100% of their mines and operations are in sub-Saharan Africa. So those are the three exceptions in terms of locations. Although I should mention DBS Singapore. Singapore is, as I mentioned, a developed market. That is a bank that's been there. It's a leading bank in Singapore. Their operations are spread all over Southeast Asia. Home base is in Singapore. Yeah.
Yeah, I just have a question on, when you're looking at within your portfolio of what you're managing, what metrics are you looking at, maybe as a policy perspective, as to how you keep balance and make sure you're not overexposed to a particular market or overexposed to a particular country? Because it sounds like you're really looking at individual countries and going, we don't want to be there. And so we're really looking at where potential is. But what are you doing to make sure that you're not overexposed in a particular country or in a particular market?
Yeah. I guess I maybe painted too much of a macro picture. We're actually focused on particular companies. We don't really worry about where they're located. It just happens that because of macro or political policies in various countries, we tend to move one to gravitate towards certain.
And I did
places.
understand that, but to me, it seems like that somewhere in there you would have some kind of underlying, that we're going to step back and look. We're going to value individual countries and where they're marketing, but we're going to step back and make sure we don't have too much exposure in the area.
So we do have one restriction from a country standpoint, and that is that we can't be more than 20%, so 2,000 basis points over the country's MSCI weighting. So just as an example, if you look on page, what would it be? Page 15, is it? That's showing the country allocations. You'll see, go to India, which I think should be around 7%. Yeah. So that we're at 25.5, that's showing. So we're pretty much bumping up against our limit there. Okay? We don't have any limitations saying we have to be invested in a particular country, though. So you can see a lot of countries where we have no weighting at all. But we do have a limit in terms of the maximum. Now, from a sector standpoint, that consumer weighting for us has tended to be 30 to 40%. It's actually that way in our other portfolios that are in developed markets too. It's been that way for a long time. I think I've explained why we like consumers. But in terms of the risk, which I think might be the question you're getting towards, we don't see a lot of risk of owning, let's say, a tobacco company that's got operations like BAT and in Russia and Indonesia and Brazil and a few other places versus a company that's a brewer, for instance, like South African Brewers, that's got a lot of operations in Latin America or in Africa. We don't think there's a connection between the two in the sense that if suddenly there's a slowdown in the economy in Brazil, people drink a little bit less, smoke a little bit less, that's going to mean that there's going to be a slowdown in South Africa or a slowdown in Nigeria. The countries are moving at their own pace in their own ways, and there really isn't a connection between the two. And typically what we see with these companies is that they will be slowing down in one place or the other. BAT, that's exposed to Russia right now, has seen a slowdown because the Russian economy is in the skids, with the lower oil price and all the sanctions against Putin right now. The economy is probably declining 3-4% this year. So BAT is seeing lower consumption, not much. People still smoke. But it's really affected us in terms of the ruble because the ruble's come down a lot versus the dollar. But that doesn't have anything to do with what they're selling in Brazil or selling in India or somewhere else. And that's the point there. These companies are so well diversified geographically that if there's a slowdown in one place, it's not going to affect them somewhere else.
So you're looking really structurally within a country as to where you want to have your exposure, and then having just kind of that macro level control of not being over a certain percentage weight over the benchmark.
Yeah, I think why we gravitate to these companies is because they're growing and they're relatively low risk. They're low risk from the standpoint that people keep buying their products, but they're also low risk in the sense that they're so diversified geographically that they can handle the different levels of growth in various countries. That's how we're looking at it. The macro part comes on the top, and that just kind of says, well, Mr. Erdogan in Turkey is not a very nice guy, and he seems to be trying to introduce more Sharia law, so it's not very friendly to alcohol companies. So let's not own any local companies in Turkey that are selling beer, for instance. And we had a couple of years ago a supermarket chain that did sell beer and wine in its stores, and we decided to sell it when he started, waving the flag about alcohol consumption. So we keep an eye on the macro. We had a year and a half ago decent exposure, about 1.5% in Russia in a couple of internet companies, privately owned companies, nothing to do with commodities, nothing to do with the Putin government. A lot of growth potential because Russians, just like Americans, just like Chinese, all are using the internet more. They're going to mobile. They're doing searches just like everybody else. But the ruble hit, and so we just decided it's probably too tough for us to call. We've cut that position down. It's about 30 basis points, 0.3% right now.
If I could just add to what Doug has said there, I think we do, and I understand your question, we do have a portfolio construction guideline framework. So I think Doug mentioned in terms of country exposure, we will be no more than 20% plus or minus the benchmark. At a sector level, we will be in a minimum of 5 out of 10 sectors at all times.
Okay.
At a holding name level, which is at a company name level, we will get into a position no more than 5%. So if we take a certain position in one of the names, we'll start at 1 or 2. We'll let it get to 5%, and then we'll let that position grow to 7%, no more than 7% within the portfolio. And then we also have a risk management system that we employ. But ultimately, it's all the the things that Doug has discussed as well.
Okay.
So,
all right. Thank you.
Thanks, Ahmed. I didn't mention, we do have some restrictions about the individual holdings, 7%, as Ahmed said, and then we have to be in at least 5 of these 10 sectors that we show you. So we do think about that, but really what we're focused on is diversifying by owning the types of companies I've talked about. We think that's the best way to manage our risk. Yeah.
Any other questions? Go ahead, sir.
My question deals with performance and your statement regarding underperformance, and that we've been with you 2 to 3 years, and that the goal is 5-8 years out in the performance in that time span. And I'm curious about your firm performance for clients or folks that are with you with a similar investment policy that's been with you for 5 to 8 years out.
You mean how they view us, or?
Performance, how you're doing performance-wise with institutions that have been with you for 5
I
to 8
see.
years.
So a longer-term performance. Do we have any statistics in here about the longer term? I think I was looking at it yesterday. I think our 5-year. Well, we've got. Yeah, if you go back to. What is it? Page
number 34 in the appendix.
Okay.
Page 34 gives you some of the long-term track record. This is about 10 years. That's our composite performance. But just one other anecdotal piece as well is, like, we do have, I know our growth has certainly been in the last 7 years per se, but we do have clients and institutional accounts that have been with us for 20, 22 years as well. Some of the long-standing ones, we've had them for a long time. But our long-term performance is on page number 34, and that's of the composite performance particularly. But we can certainly give you that to you in a graphical form. We can send it over to you guys if you want. And
Well, just to be clear, inception to date in this portfolio, you've outperformed by over 200 basis points.
that is correct. That's for this particular account that we, for your account that we are managing them for the mandate.
Right,
That
but I
one
thought he
is
said that
on-
they wanted to overperform the benchmark by 2 to 3%. Are they doing that?
Yeah.
Okay, thank you.
We do have a chart and more data around that, but it's just not in this presentation. We could certainly provide that to you.
Well, thank you, gentlemen.
Thank you.
Okay.
Thanks for your questions, too. Bye-bye.
Okay, next up is Walshaw. Aye. And I know we went over a little bit here, so hopefully we can keep you to 30 minutes, Katie.
All right, good morning, and thank you for having me. It's good to see you all. My name is Kitty Swenson, and I'm with Wasatch Advisors, and we manage an emerging markets small cap portfolio for all of you. And just briefly, I've been with Wasatch for 23 years, and the company's been in business for over 35, well, actually, sorry, it's our 40th anniversary. So I will just take a brief few minutes to give you a firm update, since it's been some time since we've been in front of you. Currently, the firm is managing just over $19 billion in assets. It's been pretty stable for the past couple of years. In this strategy, it's at $3.1 billion. The strategy has been closed to new investors for several years. For all of you, it's about $8.6 million. And as you can see, emerging markets sometimes, and over the past couple of years, has been, the flows have been a little bit volatile, but for us, given that the strategy has been closed, it's been stable, quite stable for our mutual funds, and very stable with a net inflow of contributions from our institutional accounts. Briefly, on update on the team, we, over the past year, have promoted 2 individuals really just to the position of associate portfolio manager. In this strategy, one of them, Scott Thomas, he's been with the firm for close to 4 years, and he has a long history. He's a CPA, CFA, and he was prior to joining Wasatch with Morgan Stanley and also with KPMG. So he's been a great asset to the firm. What it means to be an associate portfolio manager is really just a recognition of very good work, and then also it allows them to get more exposure to sort of the portfolio management of this portfolio. There's really no changes to report. All of our portfolio managers are also analysts. They all work together, so it's really just more of a recognition. Just to let you know, let's actually turn to page 4. I wanted to just spend a few minutes in an overview of the strategy, just to make sure, just sort of lay some groundwork as I describe what's going on in the portfolio, what we're looking for. This is a bottom-up fundamental approach to investing. What that means is that actually all of the people I just mentioned are out on the road currently visiting companies in the emerging markets. Roger Edgley, who is the lead portfolio manager for this strategy and has over 20 years of investment experience in emerging markets, small cap, He and Ajay Krishnan, one of the other emerging markets portfolio managers, are currently in China and Hong Kong. They've been there for the last 2 weeks, a trip planned prior to the huge run-up in China, but they are there right now looking at companies. Andre and Scott Thomas, the two I mentioned who are the associate portfolio managers for the strategy, are currently in South Africa. The rest of our team is in, Taiwan. Laura and Jared just got back from Australia, as well as Sri Lanka and Bangladesh, and then we have a few people in Europe. So our team spends a lot of time actually visiting the companies and visiting the markets where we're invested. Just very briefly, also, how do we manage this enormous pool of potential investments? We have a very robust front-end system that isn't a portfolio decision-making tool, but really a management tool to help us look at the companies and narrow down the potential investments. We look for, first and foremost, high-quality companies, looking at a lot of financial metrics to define high quality, and then we look at, it's an enormous database of data that's brought in from Bloomberg and other sources to help us narrow the investment field to those high-quality, long-duration growth companies that we're looking for. Then we spend a lot of time building models and then eventually going out and visiting these companies. So we have a lot of tools to help us narrow. Then we spend a lot of time very focused on actually doing some very deep due diligence on the companies themselves. That's the basic approach that we're taking to build the portfolio. On page 5, to look at the performance, we've not been with you as long as it sounds like the prior manager. We are emerging markets small cap, again, as I mentioned, but many of the comments that I'm going to make today will echo what you've heard on the specific macro comments on some of the countries and so forth. So maybe I can just give you a little bit more detail and also tell you what we're seeing from the bottom up and what we're looking for to build our portfolio. But essentially, in the first quarter, we underperformed a bit the benchmark. You'll see in a few pages to come, it was primarily from China. Our underweight in China, we're also underweight in China. I do want to spend some time talking about this because that has continued on since the end of the quarter, and we think it's a long-term story that's going to play out. Who knows how it's going to play out, but it's going to be sort of a discussion item for the next period of time, with what is going on in the China and Hong Kong markets and so forth, and then also just sort of North Asia. But we have, the Chinese markets have continued to outperform and be hot, essentially, since the end of the quarter. So there's more of this to talk about. Let's go to page 7, because I think that's more instructive on what's going on in the portfolio if we do actually talk about the countries as opposed to the sectors. As you can see on page 7, we also are significantly overweight India and underweight China. We've been overweight India for years in this strategy and in our other portfolios as well. To us, as small cap managers, India is just an enormous, attractive market with these high growth and high quality companies. A lot of the companies in India look very much like small US-based companies with management teams that have been educated elsewhere in the US. They go back. They have an approach that's very shareholder friendly. The governance is of the best quality, and it's just an enormous underserved market in India. So the pool of potential investments is vast. So if you look at our India weighting, it crosses all of the sectors. We have cement companies. We have some very small finance companies. The banking system in India is so underserved. In the rural markets, an enormous number of the people don't have a bank account. They actually use cash to conduct all of their business. And so the small banks coming in, not the state-owned enterprises, but the smaller banks have a huge opportunity to just start very basic banking in India. The growth in India, building the infrastructure, the roads, the paint companies are doing extremely well. So anyway, we see a very solid and attractive long-term story in India. So we continue to be underweight. There are macro things going on, as you heard, with Modi becoming, the leader and so forth. He is implementing a lot of business-friendly structures in place. for the markets, also for businesses to improve and to grow faster. So we think those are very good. India has done extremely well over the last 15 months, as you heard. We think, as I mentioned, but a lot of the pullback in India, which isn't significant, but there has been some pullback in the last few months, is liquidity-driven, going to China to fuel this surge in the China and the Hong Kong markets. So we're still very constructive on India, and we continue to have our overweight. Some of the other countries that we are very positive on, I'll just briefly mention before we talk sort of in depth on China. Korea, over the past couple of years, has been implementing a lot of very interesting things, we think, in the small business area. They look a lot like what Japan did years ago, currently, where they're becoming more shareholder-friendly. The chaebols are no longer sort of in charge of everything. The state-owned enterprises are not controlling the market, and these small, very dynamic, growing companies, again, have management teams educated elsewhere. We have some very interesting, and the manufacturing sector in Korea is quite interesting, and as an export market as well, exporting not just to Asia, but also to the U.S. We have a few bicycle manufacturing companies that are playing into the growth in bicycles in China and all over Asia and also in the United States. So the manufacturing in Korea, also some of the internet companies, but Korea is an interesting area for us currently. Mexico is also interesting, as Brazil has sort of gone the other way and had some macro challenges. Mexico has taken some steps to sort of systematically put in place things that are pro-business and are making it easier for our small growing companies to do business. Mexico is quite interesting. And Philippines has been interesting to us for quite some time as well. But, sort of the big story over the past, to us, longer than 6 months and so forth, but very interesting in the last month or so, is what's going on in China. And, here you can see for the portfolio for the first quarter, that is the majority of the source of underperformance to the benchmark, and it's primarily due to our underweight. We also are not going to chase performance and so forth. We do think there are some real structural changes going on in China that will benefit the Chinese market. We don't think it's all speculative. There's a lot of speculation out there going on, but what has happened is that the Chinese are basically opening up their markets to foreign investors, to people like ourselves. They've got what they've put in place, mutual market access, where there's an exchange between the Hong Kong Stock Exchange and currently Shanghai, but also they're talking about opening up the other Chinese exchanges. The Chinese market is $4 trillion. It's just enormous, and it's just growing as we speak. So what happened is essentially last year, the Chinese government announced that they are going to be opening up their market to foreign investors, which also allows the Chinese to invest outside of China. So there's this interchange of a whole bunch of Chinese money investing through Hong Kong outside of China, and a whole bunch of money now having access to Chinese investments. With that announcement, the Chinese A shares, so on that market, ran up significantly before investors like ourselves had access to them. So when we were looking at those companies before we could actually invest in them, there was an enormous run-up. So there are still all of the challenges we've had in the past to finding good, high-quality Chinese companies, and in addition to that, there was a run-up, and the valuations are not very attractive. So we're continuing to do our due diligence. As I mentioned, our two lead portfolio managers are there right now, and we were there in November, and we were there last June, and I'm sure we'll go again several times this year. It's an enormous country, lots of companies to visit. But we are finding some attractive companies to build the portfolio. We don't think it's all speculative. We do think that with all of this liquidity coming into China, it will have follow-on events that will be long-term growth for a lot of the Chinese people. So, the consumer stocks and so forth will probably have some very real growth. So there are some structural things going on that will be long-term and lasting that make China attractive. These structural changes also will probably, with all of this money and scrutiny, could make the Chinese governance in these companies improve. They will have to. So there's some real things going on. Another thing that is going on in China is that the central bank has lowered interest rates 3 times in the last 4 months. So they're doing the easing thing as well, and that is also making the markets go up. There is a lot going on in China, and we are very aware of it, and we are spending a lot of time making sure that we're not missing anything. But at the same time, we have increased our weight slightly, but we're not going to sacrifice any quality, nor are we going to, sort of sacrifice on the valuation front, just to be able to participate in this run-up. Who knows how it's going to play out long-term. We are long-term investors, and so we just want to make sure that we're not getting away from our tried-and-true philosophy and process and so forth. But we are absolutely spending a lot of time making sure that we're not missing anything in China. Does anybody have any questions? Let me pause. Let me spend a minute then on outlook, perhaps. As I think you heard, the emerging markets have gone sideways for the last couple of years, and so for the performance. So relative to the rest of the world, actually valuations, save China, are actually quite attractive. And the prior managers, Doug, also mentioned a little bit about diversification and the non-correlation between the companies in the different countries. That is a huge risk remover. They do not... In the past, when emerging markets was a new asset class, emerging markets used to sort of move in tandem. And, if the emerging markets was up, then it was up. If it was down, it was down. Now the companies and the markets tend to move out of sync, which to us is a good thing. It is good for a stock picker. We're there to find these attractive companies. So over the long term, the dislocation of the different markets and them moving not in tandem is a benefit to us. We see more and more of that going forward. So valuations are attractive. There are even more and more small companies coming out into these emerging markets as they grow and become more closer to developed. So there's just a huge pool of very attractive investments out there for us, and we're very encouraged, and the valuations actually look pretty decent in most of the markets. Yes?
Yes, so the only question I have is the same question I asked Vontobel. If you can just tell us a little bit about your, the controls.
Consumption?
Right.
Yes. Yes, so what we have in this emerging market small cap strategy is we have a 40 Act mutual fund as well as these institutional portfolios that are separately managed also. So there are even some names rules that apply to all of our emerging markets small cap portfolios. But basically, it's quite similar. We have country and sector limitations. I believe that ours are, if the benchmark is less than 10%, we can go up to 3 times the benchmark. If the benchmark is over 10%, we can go up to twice the benchmark weight. So for instance, India is 9 point something, and we can go, and we're at 20 something, we could actually go larger than that. So there are definitely restrictions in place that keep us honest and keep us from doing anything that's outsized. So there are sector, there are benchmark, and we have position holding restrictions as well, on the individual company. We may have, according to the names rule, you must be in a certain number of sectors and markets, but we are absolutely naked, Russia and a lot of the markets. So I don't think. We look at it both ways, and so to be honest, like internally, what the portfolio managers and the team say is we would like to outperform in every sector. So construct the portfolio so that we do have a weighting in each sector, building, from the bottom up with the company so that we can outperform in every sector. Every country, it's a different story. We don't have to be in every country, and we have our favorites. Mm-hmm.
Any other board members have anything? Jake, you have anything, sir? Okay. All right.
Thank you very much.
Thank you.
We value this relationship, and I'm sure I'll see you again in the not-too-distant future.
Okay. Thank you, ma'am.
Oh.
Okay. Item 3 on the agenda, approve the minutes of the meeting of April 9th. Motion been made and seconded. All those in favor signify by aye. Same sign. Ayes have it. Item 4 is receive the reports. There's 2 of them. You have the financials in your packet for the 9 months. Any questions on that? Motion been made. Are there a second? All those in favor signify with aye. Opposed, same sign. Ayes have it. 5 is ratify approval. There is 4 items on there. Motion been made. Are there a second? Second. All those in favor signify by aye. Opposed, same sign. Ayes have it. Item 6 is approve the claims docket. Motion been made. Second. All those in favor signify by aye. Opposed, same sign. Ayes have it. Approve the following applications for service retirement. We have 8 of them. Motion been made and seconded. All those in favor signify by aye. Opposed, same sign. Ayes have it. Item. There were 4 of them. Is it right? D. Yeah, there'd be 4 of them on there. Okay. Yes. Right. A, B, C, and D.
The motion was to include everything under 5, and D was the payment to Diane.
Right.
That was included.
Right. Yeah. Yeah, we done it. All right. Now where are we at? 8. Receive the report of death and authorize the payment of $5,000 and approve the continuation of pension to spouse, and there are 2 of those. Are there a second? All those in favor signify by aye. Opposed, same sign. Ayes have it. 9 is to receive the report of death and authorize the $5,000 death benefit and authorize the secretary to make the necessary changes. Motion been made and seconded. All those in favor signify by aye. Opposed, same sign. Ayes have it. Item 10 is another receive the report of death and authorize the secretary to make the necessary changes. Motion been made and seconded. All those in favor signify by aye. Opposed, same sign. Ayes have it. Item 11 is receive the report of death and death of an employee while in active service and approve the pension to the spouse. Are there a second? All those in favor signify by aye. Opposed, same sign. Ayes have it. Item 12 is approve the following application for vested rights. Motion been made. Are there a second? All those in favor signify by aye. Opposed, same sign. Ayes have it. Item 13 is ratify the approval of the following termination of vested rights and receive a lump sum payment of their employee contribution account. Motion been made. Are there a second? All those in favor signify by aye. Opposed, same sign. Ayes have it. Item 14 is discuss or authorize the audit contract with BKD, the annual audit. Renee, you have anything you want to say on this? Looks like it's standard audit that we have.
Right, this is a standard contract. The fee increase was approximately $600 over last year's amount.
Okay. What's the pleasure of the board? Motion been made. Are there a second? All those in favor signify by aye. Opposed, same sign. Ayes have it. Item 15 is the investment consultant report.
You should all have the quarterly report. I'm going to skip over the capital markets section. This is, I think it's the first time we've rolled out the complete new report. This is, I think I've mentioned, we've been working on our reporting tools, and we've enhanced our reporting a bit, made it a little bit more automated and some customized reports. So I'm just going to walk through this and highlight some things in the report. But if you turn to page 18 in tab 2, looking at the total portfolio over the last year, portfolio began the April of 2014 with $637.8 million. Net additions or cash flows of just under $20 million out. That's money coming in through contributions, less money going out through benefit payments and other expenses. Portfolio return on investment just under $50 million, $48.9 million. So you ended the month of March at $637 $67.4 million, and at the end of April, you're up about $4 million, as April was a positive month. Next, page 19, a very good, we just call this a report card page over your broad policy objectives, just a quick look at your very high-level objectives from a return standpoint over 5 and 10 years. Starting on the right, the 10-year, just as a result of market returns, slightly under that 7.5% policy objective at 6.77, so that's the only no on the page. But relative to your policy index, your portfolio has actually outperformed the policy index, so what your asset allocation would suggest over that period. From a risk standpoint, as we talk about, you've done that with less risk as measured by beta, which is or volatility, standard deviation, and then beta, which is sensitivity. This portfolio has some insurance built into it, has some strategies in it. Your riskiest asset class, if you will, emerging markets and private equity. You asked about risk controls. Both of these managers' risk controls are more from the bottom up, looking at higher quality companies with consistent earnings tend to lead them into companies that aren't as volatile over long periods of time. So these strategies relative to those markets tend to have less volatility or less sensitivity. When you look at Von Tobel's performance track record, just to highlight the kinds of things we're looking at, they didn't talk about this, but when what you would expect from them is in periods of large up markets, they will not be up as much, but when markets are down dramatically, they tend to be not down as much. And over time, that's how they've delivered their outperformance. So just to highlight from their book, because it's 2009, the benchmark MSCI emerging market benchmark was up 78%. They were up 53%, so they trailed by 25%. But we know that that's the type of market they're going to trail in. We'll take 53% to avoid the 2011 when the benchmark was down 18% and they were down 1.5%. So over time, by losing less, they make more for their investors. And that's where the risk controls come. They're pretty agnostic to sectors and countries because they're building the portfolio from the bottom up. So we know it's going to look different and you're going to have dispersion from the benchmark. But as we look at your overall portfolio construction, that's an area that we know emerging markets are more volatile, but you're utilizing managers that tend to be less volatile. And so over time, that should be a little bit defensive.
And in their decision, they're looking not only at the company, but they're also looking at the countries that they're operating in, right? I mean,
they are.
Because they're saying there's particular areas they're really trying to avoid.
Right,
basically.
they are.
But from your perspective, really, our assurance or our risk protection is more that the types of companies that they're investing
what they're
in.
doing.
Okay.
Yeah. They're not making top-down decisions to say we want to be in India or China.
Right.
India, perhaps, because they're saying there's so much growth there and so much consumer growing middle class. That's the other theme that I don't think either manager really expressed. When we look at emerging markets, one of our intermediate to longer term themes is their higher growth potential due to a large and growing middle class, creating increased domestic demand within those countries. When you look at the emerging market indices, there's still a big percentage of the index, the companies in the index that are going to rise and fall as a result of developed market demand for exporters of raw materials or the Petrobras's, the Taiwan Semiconductor, Samsung in Korea. Those are big names in the index that tend to be driven by developed market demand. Neither of these strategies are really exposed to that to a great degree.
So technically, I mean, kind of back to what Randy asked about, as they're looking at their portfolio, I mean, technically the emerging market is defined by where the company's located, but they are actually managing to try to target the emerging market as the end user.
Yeah, more or less. I mean, it's going to be built more on companies that are driving their growth through demand in emerging markets. So it's not the UK example. I mean, that's a small piece, but the underlying revenue drivers are emerging markets.
But just within the industry, if you're talking about emerging markets, you're really, as a technical definition, not saying you can't be in other markets, but as a technical definition,
Right.
it's looking at where it's located, isn't it?
Technically, I mean, the benchmark MSCI is defining the emerging markets based on GDP growth and certain other qualitative factors.
Like Von Tobel was saying, they're not looking to target companies that are located in an emerging market and then trying to market back to a developed country.
No.
Not as a strategy.
Not as a strategy.
Okay.
That's why you see so much consumer staples, because that's going to really be driven by growing middle-class demand and the like. So just back to the portfolio risk statistics and results, the 5-year, you see yeses across the board. Portfolio is over a 10% return over the last 5 years relative to that 7.5% absolute objective, and again, above your policy objective with less risk. Next page shows the asset allocation as of the end of March. Continue to be slightly over-allocated to equities. You'll see we've got the dollar amount over under for just ease of for rebalancing use. Continue to be within equities. Small cap continues to be the most overweight, about 4% overweight, which represents about a $27.2 million overweight. But within allowable ranges, we would suggest that your monthly cash needs still come from small cap until we get that down a little bit. Fixed income, slight overweight. Real assets, slightly underweight to the target, 3.3%. Most of that is the opportunistic real estate, which, as you know, is more like private equity. It's called down and put to work over time. That's an area we need to continue to build out. Page 21, we've added this page just to drill down on EM exposure and where it is, because you do have some emerging market exposure outside of your dedicated emerging market managers. Just to be clear, when we're looking at these targets, we are, on page 20, we're focused on the dedicated emerging market managers. So that 5% policy target that we're measuring on page 20 and showing you're at 4.5, that's not drilling down all the way to the security level. That's looking at the two managers, Wasatch and Von Tobel. To get another view of that, on page 21, we are showing a drill down. And from an equity standpoint, you're at 6.48%, and that's across a number of managers. So you do have emerging market exposure through your global long-short equity manager, which is by design. They're allowed to have some emerging market exposure. It's about 9.25% of K2's portfolio, which represents 95 basis points at the overall portfolio. Then Lazard and Harding Levner, they were in a couple months ago, and I think that's what started us talking about this. These are your developed market managers. They do have the ability on an opportunistic basis. They're more looking at, again, still at companies, that they're looking for good companies. The fact that they might be in an emerging market is not an emerging market decision as much as we want to be in that company in the energy sector or in the technology sector. So there it's going to tend to be more of those bigger names that are driven more by global demand than local market demand. You might see the Petrobras's and the Samsungs and those types of names in those portfolios, but it's about 0.5% of those portfolios. You also have some exposure on the fixed income side by design. This, again, wouldn't be in that 5%, but we've intentionally allowed some managers to have the ability to diversify fixed income. So you're getting some EM debt exposure, emerging market debt exposure through Western in the Core Plus strategy, PAMCO in the low volatility hedge fund strategy, and then Brandywine has a bit of that too. That is a global debt strategy. They're investing opportunistically in primarily sovereign debt, government debt across the globe, so it might include some emerging market as well. Page 22, just still looking at total portfolio statistics, some risk statistics. We already really touched on these, but the upper left, this is going back to January of 2002, so not quite 13 years. It's, I guess, 159 months. This is when we started calculating performance. The upper left shows that you've gotten a little bit more return than the policy index would suggest, with less risk, which is what we would expect. You see those numbers in the top right, 6.63% return, where the policy index or the asset allocation would suggest a 6.5% return. So this includes difficult market environment, early 2000s, and then the market crash of 2008. Other risk statistics, beta, less than 1, meaning less sensitivity to the direction of the policy index or the markets as a whole. Up capture, down capture, you're not getting all of the upside, but you're getting less of the downside, which is what we would expect. Page 23, so we have gone back and tried to backfill some net of fee data. And there were some questions about this, and one of the issues is you pay your fees out of an account not at JP Morgan, an account that we don't see. So what we've done is gone back 3 years just so you'll have this data, and we're basing this on estimates of and confirming with the managers what their net of fees would be. The reason why we're not doing actuals, one is we don't get it, and the other is because of timing of payments, it may make things look funny. What I mean by that is you could make a payment for 2 quarters if you did it on a cash basis in August, and so that's going to hit a manager or the total fund portfolio performance at an odd time and not line up with the benchmarks. But we're showing that here. So over 3 years, the portfolio is about 10.9% return, net of fees, 10.28% return net of management fees. This isn't all fees, just to be clear. This is asset management fees. So there are other costs associated with running the plan, custodian, consultant, although that's so de minimis it would hardly show up. It's a rounding error.
Minor skis, right?
Also on that page, just the portfolio rankings relative to other funds with 55 to 70% equity. It's nice to point them out when they're good. We don't really, what it tells you more than anything is what your asset allocation looks like relative to others, but currently over a 1-year period, you're in the ranking is kind of there in the middle of the page for the portfolios in the 35th percentile of other funds with 55 to 70% equity. I'd say that's very good considering how much less risk that you have compared to a peer group of funds that have quite a bit more equity. You're at about 60% in equity, some of which is hedged, the hedged equity. Over 3 years, top 32%. Over 5 years, 42nd percentile, and 10 years, just below the median. Going to page 25, we do have returns of managers and such. Top line, again, showing that same data, total portfolio over these periods. And then the second line with the asterisks, that's the net of fee line, again, and we have that back 3 years. Roughly, and this isn't going to match up exactly because portfolio values move up and down, but you're roughly at about 65 or so basis points on a weighted fee across your portfolio. One of the things that I will point out from a manager standpoint, all of your managers look very good. Active management is starting to turn around. You're starting to see fundamentals matter a little bit more over the last 6 months or so as quantitative easing, particularly domestically, has started to wane. That was a big headwind for active managers to be able to keep up with the markets. But you're starting to see that fundamentals mattering again. So on a 1-year basis, just looking at your active managers in tech, about 2% over the benchmark. They're up 14.95 relative to the benchmark 12.73 on a 3-year basis, or 5-year basis. They're all 125 basis points over, ranking the top 16 percentile. Skipping down to the other active managers, Times Square, 3- and 5-year basis, outperforming their benchmark in the top quartile. Ernest Partners, big turnaround. One of the things that, as we look back a little bit, peer group rankings over 5 years, we show 2 different peer groups, small to mid and small. This is a small to mid strategy, right around the 40th percentile over 5 years, so looking very good. 10 years a little bit, they're up 8.8%, ahead of their index by 60 basis points, trailing peers. Some of that is periods of time, you may recall, when REITs have done well, which has been a couple of different times over this 10-year period. They tend to really avoid REITs altogether. In the small cap value space, REITs make up about 13% of the index. So periods when REITs run, they're going to trail. REITs have sold off a bit recently, and they've done very well. Their one-year return of 12.4%, outperforming their index, which is up 6.5%, and peers, they're in the top 18, really 20 percentile versus small to mid cap managers and top 8% relative to small cap value managers. Long short equity in a period of time where equities have been going up has been additive, outperforming your total fund. So a lot of times long short equity can be a bit of a headwind, but this has been a good market, and I think this really speaks to fundamentals starting to matter again. As you see, K2 is up 9.6%. We show the composite, and then we show K2. They're the only fund in the composite. The real benchmark there is the HFRI fund-to-fund strategic. Below K2, we also show the S&P. More relevant comparison for K2 and the S&P is on the risk side, and from a risk standpoint, they're about half the risk of the S&P 500 over time. Looking at the international managers, while on an absolute basis not as good of returns as domestic markets, as U.S. markets have done quite a bit better over the last year, that's turned around in the quarter as international markets have outperformed U.S. markets in the quarter and year to date. Emerging markets just last month were up 7%. The emerging market index, emerging market small cap, was up 9%. But on a relative basis, your international manager is doing well. Harding Leavener up 5.25%, over 500 basis points above the ACWI index, and ranking in the top 14%. So pretty good peer group rankings across the board. Lazard, again, on an absolute basis, 2.8% return, not great compared to what we've got domestically, but we know things move back and forth. For the quarter, they're up 5%. But ranking in the 17th percentile and above the benchmark, the EFI benchmark, which was negative for the period. The 2 emerging market managers that were just here, a month makes a huge difference, but if we're looking at one-year numbers at the end of March, Von Tobel up 6%, benchmark up 79 basis points, ranks them in the 16th percentile. Oddly enough, very different portfolios. Wasatch has the exact same return, 6.07%. I had to look at that a couple times, but that is correct. Again, in the 16th percentile. Not the differential relative to their benchmark, because the small cap benchmark did a little bit better, not quite as much, but still almost 5% over that one-year period. I mentioned a month makes a huge difference. The month of April, emerging market benchmark was up over 7%. Emerging market small cap was up over 9%. You heard the 2 managers talking about that. A lot of it was China. A lot of it was larger names in the benchmark deriving return primarily from global market demand or pickup in demand from an improving Europe and U.S. Your managers aren't going to do well on a relative basis in those kinds of periods. So now the one-year returns, you just move forward a month, are trailing. Longer term, you don't see these numbers in your book. Longer term, both of these managers have very good returns over 5, 10-year periods. On the fixed income side, Western Core Plus manager, which is a significant amount of your bonds. You have $74 million with them, which is 11% of the total portfolio, so we're overweight to Core Plus. Within bonds, up 6.5% relative to the ag, up 5.7% in the 16th percentile. PAMCO, absolute return, this has been a bit of a headwind, so low volatility strategy over the last year, not benefiting from not having interest rate exposure, as interest rate exposure actually helped over the last year with interest rates coming down. More recently, things are a bit better, up 2.5%, when the ag was up 1.6% in the quarter, and you started to see interest rates backing up now. The 10-year has gone from about 1.8 to 2.3 during the quarter, so about a 50 basis point increase. This is longer term. The portfolio is really positioned to be less sensitive to rising U.S. interest rates, but you did get some benefit in both the index strategy and WAMCO over the last year. The global bond strategy, this is a diversified non-U.S. or diversified global opportunistic strategy, up 2% over the year over year, well ahead of the Citigroup World Government Bond Index, but again, compared to U.S. investment grade bonds, not as attractive, primarily because of rates declining over that one-year period. Longer term, we will continue to believe that this is a good diversifier. They were actually able to do well relative to the benchmark because they had limited to no weight in the euro exposure to the euro or to the yen, and they had a lot of dollar exposure. So it helped them. They just don't have as much as a 100% dollar-based index. But again, relative to their peer group, top third of the peer group. And then on the real estate side, your core real estate strategy up almost 16%, so very good returns from an absolute basis and a relative basis. So relative to other asset classes, it's actually your best performing strategy across your entire portfolio, outperforming equities and all your equities and bond strategies, outperforming the index and the top third of peers. We would expect this Morgan Stanley Prime Real Estate Fund to do good in a period where real estate is doing well, tend to have a little bit more leverage than some of the other funds in the peer group, so they do well when the market's going up. I think if we talk to them, and as we have, and talking to them and other core real estate managers going forward, core real estate's a little bit frothy now. Prices have really run up. Expectations going forward should be more realistic with our long-term assumptions, which are more in the 8%, 7 to 9% range, probably coming in somewhere around 8. So that's kind of the income, primarily income with a little bit of price appreciation. Prices have run up quite a bit in this market. Finally, commodities, you've got short period of time with them. Commodities are down. It's a small percentage of the portfolio, down 5.7% for the quarter. But overall, I think a very good report. Hopefully, the enhancements are helpful. Just one last thing, and I won't touch on this. We are showing in the back on the manager pages, in the return tables, we have manager net of fee returns too, and we went back 3 years on that to show those as well.
Any questions?
Yeah, I have a couple items. One, I just want to thank you for doing the emerging market exposure analysis. That certainly makes me feel better, and I appreciate you doing that. Second item, is my understanding the net of fee returns does not include custodial fees and the very small consultant fees and some other fees. About how many basis points is that, the other fees?
It's less than probably 5 to 10 basis points.
Okay.
That's my estimate. I mean,
It's not more than 10?
No.
Okay.
They're not all fees you're managing, right?
Well, a custodian is not.
We have that one. I mean, the city.
Oh, you mean
the system? I mean, the URS system is actually managing a contract.
Right. I mean, I don't know what other there might be other expenses that the system has. You know, the general administrative expenses, which are de minimis. I mean, these are the vast majority of the cost of running the system or asset management fees. Right, right.
Well, I have a question, Mr. Chair. Jason, I attended the NCBERS conference last week, and one of the things during one of the workshops that they talked about were the increasing fees by the index funds and passed on to the custodians, and that they were pretty significant or were going to be pretty significant. And, of course, those custodial fees were ultimately going to be passed on to the client. Are you aware of any of that that's going on?
Well, custodians have been trying to, they're getting squeezed because one of their primary sources of revenue, securities lending, has been not quite eliminated, but many investors have gotten out of that. So before, a lot of custodians would give you a pretty big break on custody fees if you were participating in lending. The same on their index funds. If you were in the lending version of index funds, you oftentimes got a fee break from the non-lending. But I wouldn't say it's significant. The bigger significance is, and we moved you to all non-lending funds, because what you may recall happened is when you needed money, if you were in those lending funds that were reducing your fee from 3 basis points to 1, you were unable to tap into your money in 2009 and 10. So I don't know that it's a major issue. I mean, we're still, in addition to looking at the fees and incorporating them in here, we do go back to your managers, all of your managers, every year and make sure that you're getting the best fee available for your size and the mandate you're in, as well as benchmarking the fees relative to the broader peer group based on what you're in. So you have very good fees.
So following up on Randy's question about the additional fees that are charged, you're saying that we're not paying any more than 5 or 10 basis points?
No, I don't believe so. And we can look at that. I'd have to work with Renee to do that. I mean, I don't know what your custody fees are exactly. We've looked in that in a while.
Renee can just follow up and get us that information.
So it's
She can just email us that
$120,000.
information.
Okay, so
She'll follow up and get it for us.
if I had a calculator, I could do that math, but I can't do it in my head.
Well, I think what you're talking about is the custodians wanting to jack the fee up for managing.
Yeah, but it's because of according to the seminar, it's because of the benchmarks. And I have to say that this was a panel discussion, and 2 of the panelists were from NASDAQ, and NASDAQ now has an index fund. I think that they're marketing. But 2 of the other panelists were clients, and they were using this NASDAQ index fund. And they were talking about the substantial fees that they had seen from some of the other index funds that had been passed off to the custodians, and the custodians were passing those off to the clients.
Did you talk about that there was fee increases on the index funds?
Yes.
The index funds that you're in were increasing their charges because their costs were going up, being charged by the other, like NASDAQ, for instance.
Well, not exactly. The custodians of the funds.
Of those funds, not
Yes.
your custodian, but the
Right.
custodian of the funds.
Yes, the custodian of the funds were previously absorbed those fees that were charged by the index funds, and now those fees, what they stated in this seminar is that those fees were increasing pretty dramatically, and so now those fees were being passed off to the consumer. And so for us as trustees to monitor that very closely.
And that is something that we do look at, but it's also, so your index fund fees haven't gone up, and this is what was, but aside from that, when you're invested in commingled funds, you do need to look at the total expense, but oftentimes a primary reason for investing in a commingled fund is because you're getting benefits of scale, not just on the asset management side, but the administrative side. And that's what Amit was talking about in the Von Tobel Fund. the asset management fees aren't going down as much as the administrative and custody fees. As the assets in that fund go up with other investors, you're getting the benefit from that. For you to go directly, particularly in those international markets, and open those accounts with J.P. Morgan, the cost of the custody and clearing would not be worth you investing in those.
So you're seeing that primarily on the separate accounts, or that would probably
Well, I'm
apply
thinking
more-
what they must have been talking about is in some commingled funds, that the fees, the expenses are going up from, that the custodians are charging. So we're looking at that from a total expense ratio. I don't see in the index funds that you're in with State Street, your costs aren't going up. They're still very small. And that's the other benefit of being in large index funds. The State Street S&P 500 index fund's over $1 trillion, and the Ag Fund is similar. You're getting the benefits of that scale. So I'm not doubting that fees may be going up, administrative fees in some index funds, but it'd be interesting to see what types of index funds those are. If they're non-U.S., small cap, more illiquid markets, that may be where it is.
Thank you.
Anybody else? Okay, item 16, comments from board members, anybody?
I was just going to say that the conference was very good, as it always is. I think they had some very good subjects. The one, of course, I did focus in on was the index funds and the trustees' responsibility for monitoring those fees and making sure that that it was transparent in terms of what impact that had on our overall returns. So it was a very good conference, and those of you who have not attended the conference previously, I do recommend that you consider it in future years.
And it's in San Diego next year? Yes. Anything else? Anything else? If not, we're adjourned at 11:42. Thank you all so much.